Apple has been the crown jewel of innovation for decades, but is its shine starting to fade? With revenues stagnating, new products struggling to wow, and AI rivals surging ahead, the big question is, can Apple keep its throne, or are we watching the beginning of its decline? Let's dive in. I always start with 5 dimensions, a proprietary system where I dissect the fundamentals of a business. Let's kick off with the first dimension, growth. Over the past decade, Apple's revenue soared from $233.7 billion in 2015 to a peak of $394.3 billion in 2022, a steady 10-year annual growth rate of 5.3%. However, the past 2 years tell a different story. Revenue has plateaued, sitting currently at $391 billion. Net income paints a similar picture. From $53.4 billion in 2015, Apple hit $99.8 billion in 2022 before slipping to $93.7 billion in fiscal year 2024. But things for earnings per share look better. Thanks to Apple's aggressive share buybacks, EPS has grown at an annual growth rate of 10.2%, nearly double the rate of net income growth. With shares outstanding reduced by 33% over the past decade, Apple has amplified EPS growth even in periods of slowing growth. It's a masterclass in capital return. Then there's free cash flow, Apple's financial backbone. Free cash flows peaked at $102.4 billion in 2022 and stabilized at $97.1 billion for fiscal year 2024, a testament to the company's operational strength. This cash funds buybacks, dividends, and innovation, keeping Apple's financial fortress intact. What's driving this growth? The iPhone remains the anchor, but growth here is slowing in saturated markets. Apple's services segment, including Apple Music, iCloud, and TV Plus, has stepped up as a high-margin growth engine, while wearables like AirPods and Apple Watch provide incremental gains. But the big concern? Stagnation. Revenue and net income have flattened, reflecting a lack of breakthrough innovation. And in the critical AI space, rivals are leaping ahead while Apple Intelligence struggles to live up to expectations so far. Now, let's shift gears to profitability dimension. Gross margin has been on a steady climb over the past decade, rising from 40.1% in 2015 to an impressive 46.2% in the most recent fiscal year, 2024. This reflects Apple's strategic focus on high-margin segments like services and premium hardware, coupled with efficient cost management. Next, let's talk about free cash flow margin, which has seen fluctuations over the years. From a peak of 28.3% in 2015, it has stabilized closer to its 10-year average of 23.7%, with the current margin at 24.8%. While this is an improvement from 2023's 23.2%, it highlights Apple's challenge in expanding margins further. Now to the standout metric, return on invested capital. Apple has excelled in generating exceptional returns, climbing from 31% in 2015 to a remarkable 46.4% in 2024. This is well above the 10-year average of 34.4%, driven by high-margin products, disciplined capital allocation, and aggressive stock buybacks. Moving on to the solvency dimension. Quick ratio has steadily declined over the years, dropping from 1.33 in 2020 to 0.83 today, below its 10-year average of 1.09. This means Apple now has fewer liquid assets to cover its short-term liabilities. The sharp decline post-2020 reflects Apple's increased focus on deploying cash toward share buybacks, dividends, and capital investments, reducing its liquidity buffer. While this decline isn't an immediate concern due to Apple's operational strength, it highlights a reduced margin for handling short-term obligations. Moving to debt to equity, Apple's leverage has increased significantly over the last decade. The ratio peaked at 2.37 in 2022 before improving slightly to 1.87 today. This is well above the 10-year average of 1.45, reflecting Apple's strategy of using debt to fund aggressive shareholder returns and investments in growth. Although leverage is higher, Apple's robust cash flow generation and operational efficiency provide a strong cushion, ensuring debt is manageable despite elevated levels. Now for the standout metric, debt to free cash flow. This ratio, which peaked at 2.46 in 2017, has steadily improved, reaching an impressive 1.10 today. This means Apple can pay off its entire debt load with just over a year's worth of free cash flow. Now the important fourth dimension, valuation. Enterprise value to sales has skyrocketed over the last decade, climbing from 2.9x in 2015 to a staggering 9.9x today. This is well above its 10-year average of 6x, reflecting the market's increased confidence in Apple's high-margin services and cash flow generation. A big driver of this surge is the announcement of Apple Intelligence, which has sent Apple's stock soaring to historical peaks. Investors are betting heavily on this initiative, expecting it to revolutionize Apple's business and establish dominance in the AI space. Now let's look at price to earnings. Apple's P/E ratio has surged from 11.7x in 2015 to an extraordinary 40.3x today, marking a new peak far above its 10-year average of 24x. Apple's valuation metrics reflect an incredible level of investor confidence, driven by its transition to services, strong cash flows, and excitement around Apple Intelligence. However, the numbers tell us the stock is priced for perfection, and any deviation from these high expectations could lead to significant downside. What do you think? Can Apple Intelligence and its services expansion justify these sky-high multiples, or is the stock headed for a reality check? Let me know in the comments. And don't forget to like, subscribe, and hit the notification bell. The fifth and last dimension is the shareholder's return. Apple's dividend per share has grown steadily from 49 cents in 2015 to 98 cents today, reflecting a 10-year annual growth of 7.1%. However, recent years show a slowdown, with a 5-year annual growth of 4.2%, as Apple shifts more cash toward buybacks rather than dividends. Dividend yield, on the other hand, paints a more challenging picture for income-focused investors. Apple's yield has dropped from 1.8% in 2015 to just 0.4% today, far below its 10-year average of 1.0%. This decline is due to two main factors: massive share price appreciation, which compresses the yield; slower dividend growth, which hasn't kept pace with Apple's valuation. At just 0.4%, Apple's dividend yield is among the lowest in a decade, making it less attractive to those seeking regular income returns. Now for the highlight: shares outstanding. Apple has aggressively reduced its share count from 22.73 billion in 2015 to 15.24 billion today, a stunning 33% reduction over the last decade. Did you hear correctly? Apple bought back over 1/3 of its outstanding shares over the last decade. Insane. This buyback strategy has been a cornerstone of Apple's capital allocation, enhancing EPS growth and driving shareholder value. Although the pace of buybacks has slowed in recent years, the consistent reduction underscores Apple's commitment to rewarding long-term shareholders. Here are the ratings for the first dimension metrics and their average. The second dimension, profitability. The solvency dimension is rated as follows. The fourth dimension, valuation. And finally, these are the ratings for the fifth and last dimension. In this table, we have a summary of this section. The 5 dimensions final rating is 3.1. Now let's move on to Apple's DCF valuation. I employ Wall Street analysts' free cash flow projections to compute Apple's fair value. The average estimates of the next 5 years are utilized for a base case scenario, the highest estimates for a bull case scenario, and the lowest estimates for a bear case scenario. The base case estimates Apple's fair value at $204, which is 17.5% below the current stock price, highlighting significant overvaluation. The bull case values Apple at $289, which is 16.6% above the current stock price, signaling undervaluation if Apple is able to grow at these forecasts. In the bear case, Apple's fair value is pegged at $139, a striking 44.1% below the current price. Moving on to the reverse DCF valuation method, we can uncover the growth expectations baked into Apple's current stock price required to generate a 12% annual return, my required rate of return. By analyzing the free cash flow growth rate needed to justify its valuation, we assess whether the market's optimism is grounded in realistic performance or if the stock price is pure speculation. Let's dive into the assumptions and results to see if this method also highlights overvaluation for Apple's stock. Assuming an exit multiple of 25x in 5 years, the results show the implied free cash flow growth needed to generate a 12% annual return is 16.2%. In comparison, Wall Street's average projected free cash flow growth for the next 5 years is 12%. This gap of 4.2% suggests the market is pricing in an exceptionally optimistic scenario, one that exceeds even bullish forecasts. This leaves us with some key questions to consider. Can Apple realistically achieve a 16.2% FCF growth rate? Apple's scale and maturity make it challenging to sustain such high growth rates. With annual free cash flow already nearing $100 billion, even modest percentage increases require massive incremental cash generation. Are catalysts like Apple Intelligence enough? While the market is betting heavily on Apple Intelligence, the initiative's potential remains uncertain. Can it truly deliver the transformational growth needed to justify these elevated expectations? Is the market overvaluing Apple's historical success? Investors may be assigning too much weight to Apple's past performance, underestimating the difficulty of maintaining double-digit growth at this stage of the company's lifecycle. My last valuation model is Apple's expected yearly return model. This model provides valuable insight into what investors can realistically expect at the company's current valuation, and the results raise concerns about whether the stock can deliver satisfactory returns. Let's break it down. The expected yearly return breakdown is as follows. Expected EPS growth is projected at 12.8%, shareholder yield is 2.8%, with the major contribution from a buyback yield of 2.5%. Dividend yield at 0.4% and debt paydown yield at -0.1% are negligible contributors. When it comes to valuation impact, the current PE is 40.7x, expected to compress to an exit PE of 25x. Altogether, this results in a total expected yearly return of just 6.5%. At 6.5% total expected yearly return, Apple's projected performance falls well below my required annual return of 12%. The primary reason? Valuation compression. With Apple trading at a current PE of 40.7x, the assumption of a more reasonable exit PE of 25x over time creates significant drag on returns. This compression offsets the benefits of EPS growth and shareholder yield. Together, these factors aren't enough to overcome the headwind caused by Apple's elevated valuation. While Apple remains an outstanding business with impressive operational efficiency and shareholder return strategies, the stock's current valuation suggests caution. At a 6.5% expected yearly return, entering at these levels may not align with the return goals of many investors. Now is the time to wrap up everything. Apple remains one of the most valuable and admired companies globally, standing tall on the pillars of its robust cash flow, ecosystem dominance, and unwavering brand loyalty. However, this analysis uncovers a nuanced picture of its strengths, challenges, and future prospects. Let's dive into the key takeaways. Apple excels in profitability, boasting a 46.4% ROIC and continually improving gross margins, driven by high-margin services and premium products. Its operational excellence and cost discipline are unmatched. Through aggressive share buybacks, Apple has reduced its share count by 33% over the past decade, amplifying EPS growth and returning significant value to shareholders. While dividend growth has slowed, it remains at a steady growth. Despite recent stagnation in revenue, Apple generates $97 billion in free cash flow, enabling it to fund innovation, buybacks, and dividends while maintaining financial flexibility. However, concerns loom. Revenue has stagnated at $391 billion since 2022. Slowing growth in net income and free cash flow raises questions about Apple's ability to sustain its historical momentum. With a yield of 0.4%, Apple's dividends are less appealing to income-focused investors. The company's emphasis on buybacks further limits its attractiveness as a dividend stock. Market enthusiasm for Apple Intelligence has driven valuations to historical peaks, but it remains unclear whether this initiative can deliver the transformative growth needed to justify the hype. Concerns are mounting that Apple's innovation may be waning. For example, the company invested billions in Project Titan, its ambitious endeavor to develop an autonomous electric vehicle. However, after a decade of development challenges, strategic pivots, and leadership changes, Apple canceled the project early this year, reallocating resources toward generative AI initiatives. Lastly, Apple's App Store practices are under intense scrutiny. The company imposes a 30% commission on app sales and in-app purchases, a policy that has sparked legal challenges worldwide. In the United Kingdom, Apple faces a class action lawsuit seeking up to $995 million in damages, alleging that these fees harm competition in the UK tech industry. Similarly, in the United States, a class action lawsuit accusing Apple of monopolizing the iPhone app market is set for a jury trial in February 2026, with potential damages estimated between $7 billion and $10 billion. These developments raise questions about Apple's future direction and its ability to maintain its innovative edge in an increasingly competitive tech landscape. At its current valuation, Apple's stock is priced for perfection, with little room for error. The combination of plateauing growth, elevated multiples, and lofty expectations for initiatives like Apple Intelligence creates a challenging risk-reward balance for new investors. While buybacks and strong profitability provide a cushion, achieving double-digit returns will likely require substantial growth from new initiatives or transformative innovations. For investors seeking a 12% annual return, Apple might not be the best bet. However, I recognize I may be underestimating the true potential of Apple Intelligence and its ability to drive higher growth and profitability. This is why I plan to dive deeper into Apple's business and evaluate its future impact. Final verdict. Analysis 2.0. What do you think? Are you bullish or bearish on Apple's future? Let's continue the conversation in the comments below. And if you found this analysis valuable, don't forget to like, subscribe, and hit the notification bell for more in-depth breakdowns like this one. See you in the next video.